Welcome to the Utah Homebuyers Quest podcast with Nelson Bars. Our mission is to give you hope, knowledge, and encouragement on your quest for home ownership.
Housing affordability is at its worst point since 1986.
Higher mortgage rates are impacting Utah's housing market. Potential buyers out there being priced out.
It's getting tougher by the day to afford a home.
Many factors are making it very, very difficult with no relief in sight.
Homeownership may seem like an impossible mountain to climb in today's world. We're here to say that it is possible, and we're here to be your guide, to climb with you, to urge you forward all the way to the closing table. We believe in home ownership, and we believe in you.
Well, hello, homebuyers. Welcome back once again to the Homebuyers Quest podcast. Thankful that you're here, and I congratulate you again for being here. This is just one more step in your journey up the mountain towards homeownership, and I'm here to take it with you. My name is Nelson Bars. I'm a mortgage broker here in Utah. As I say, I've helped thousands of people purchase homes, and I'm here to help you. And today, I want to talk to my self-employed friends, all of the business owners out there who want to get a house. I know there are a lot of you. And today, we're going to talk about 5 tips to help you, specifically focused on income. You know, that's the challenge with business owners, is getting an underwriter to see your income. So we're going to talk all about that today. I had a consultation yesterday that has kind of spurred this on. A client who heard me on the Frankie and Jess podcast a couple weeks ago. I had the opportunity to be on their show. They're a local Utah podcast. I was on their episode that aired on April 30th, if you want to go check it out. And we talked all about home ownership and the value of it, and how to pull it off in today's market. And I want to just thank them for the opportunity to be on their show. It was such a great thrill to go check out their studio and see how they do it. And thank you very much. So this client heard the show, and she called me and scheduled a loan consultation. And she told me that she and her husband run a business together, and they've wanted to get a house for a long time. The problem is tax returns. They're trying to show the IRS as low profit as possible, right, so that they don't pay too high of taxes. And I want to share with you the advice I gave them. She told me they've been trying to get ready. They've had a struggle with lenders and not been able to get approved. And they wanted to look at not only how they can improve their income, which is what I want to focus on today, but what they can do with their debt structure, because it's all about that debt to income ratio, right? So the other half of my consultation with her, I've already covered an episode about that. If you go back to the episode entitled How to Fix a Broken Debt to Income Ratio, you'll see kind of half of what we focused on. But when it comes to income for self-employed people, there's 2 ways to get approved. You can go the conventional route, which, you know, the income underwriting is the same for any conventional FHA, VA, USDA loan program. They're going to calculate and look at your tax returns. Or you can go the non-QM route, where they can use bank statements or a profit and loss statement or 1099s to verify your income. I always try to help you fit into the conventional first, and that's just because it's a better interest rate, much better down payment options, and you have all the programs available to you, like I said. They all require a 2-year average of your income tax returns. And when they do that, they're not looking at the top line, they're looking at the bottom line profits, right? Anyway, so for this episode, I want to focus first on how to get you approved for a conventional mortgage. And after that, we'll talk about non-QM options and how those work. I think that's the order of operations you should go through when you're trying to get a mortgage. So first thing to understand, the 2-year average. I have a lot of clients who had one bad first year, and then the second year, the business kind of took off. And they'll call me and they'll say, okay, I want to buy a home. The problem is that the first year has to be included in the average. So it's like this anchor, right? You have a 0 for year 1 and $100,000 for year 2. And we're gonna average those 2 together, and it's going to look like $50,000 a year. So many people have to wait for the 3rd year to end, where they have 2 good consecutive years, or at least 2 growing years of profitability, and we can average the 2 together. Now, wouldn't it be nice if you could just throw out the older year, the 0 year? Well, you can't do that with a new business, but I do want to make sure you know that the guidelines often allow for a 1-year average if you've been in business for 5 years or more. So that's tip number 1 here. I'm going to go through 5 tips for self-employed people. And tip number 1 is that if you're in that boat, if you've been in business for 5 years or more, and you're waiting for an old bad year to drop off, unless if it's last year, then you have to wait, right? But if it's the year before, don't wait. We can actually ignore that year and use a 1-year average to get you qualified. When we calculate your 2-year average, like I said, we're looking at the bottom line. So I have many business owners who tell me their top line number, we made $300,000, for example, and it doesn't even matter, right? We don't even look at the top line. It's about the net profit at the bottom. Both the IRS and your underwriter just focus on that net profit at the bottom. And so if you show $300,000 at the top and $30,000 at the bottom after you write off all your expenses, we're going to have to use the $30,000 to get you qualified. However, that is not the end of the story, and unfortunately, a lot of people, including loan officers, will stop right there. If you're looking at your bottom line, or worse, if you had a credit union or someone look at your bottom line and say, you don't make enough money, I want you to just pause for a minute because you have add backs. So tip number 2 is to go ahead and submit 2 full years of tax returns and let me do the full underwriting calculation, because we're going to take advantage of all the add backs in the mortgage guidelines. I once had a client, she and her husband got declined by a credit union because their income was too low, and I asked her, just send me 2 years of taxes. Just let me do the work of calculating your income the way the underwriters will do it, and we'll see how much income you have to qualify. I didn't do some creative lending program. I just did the proper income calculation. First, we threw out the old year, and we focused on a 1-year average because the most recent year was better. And the second step was to add back all of the items that they wrote off, that Fannie Mae, Freddie Mac, FHA, VA, USDA, they all allow us to add these back. These are depreciation and depletion. This is the biggest one, and I'll explain it in a moment. Any salary you paid yourself can also be added back to your bottom line, and any one-time expenses that you wrote off, such as theft or disaster, we can add those things back if we can prove they're not an ongoing expense and not a regular part of your business. And once I did that for her, they had plenty of income to qualify, and we proceeded with a conventional loan for them. And honestly, I've done that for many clients who have been told by a lender they don't make enough money. It's just a matter of going through the work, the actual worksheets, to see how much income we can pull out of your tax return to get you qualified. So let's get back to that client that I met with yesterday. I looked at her tax returns, and they had about $150,000 of revenue at the top and only about $50,000 of profit at the bottom. I looked for things that I could add back to that $50,000, and there was 0 depreciation. So I'll explain what depreciation is. And first, I just have to say I'm a mortgage guy, not a tax advisor. So please seek qualified and licensed help with your tax decisions. What I'm going to focus on is how your tax decisions affect your mortgage application. Now, depreciation is when you spread a capital expense out over time. The easiest example I can give you is real estate. If you were to buy a building for your business and you spent $700,000, you wouldn't want to write off $700,000 in year 1. In fact, the IRS wouldn't allow it. They make you spread it out. I think property is spread out over 27 years. So you divide a fraction of the cost in, and you deduct a fraction of the cost out over the time of that useful asset. Everyone does this with rental properties and real estate. That's pretty common. But you can also choose to depreciate smaller things like vehicles, trailers, tools, computers, basically any equipment that you buy. And there's also a thing called bonus depreciation right now where you can actually call an expense depreciation and still take all of it or most of it as an expense in the year you bought the item. So I've often had accountants for my business ask me if I want to expense an item or depreciate it. And we'll just look at, okay, how much can I depreciate this year versus how much can I expense right now and what's the tax consequence there. But the word depreciation is a magic word for mortgage underwriting, because if you call it an expense, I cannot add it back. If you call it depreciation, you still get the tax savings, but I can add it back to your income for qualifying. So I asked this client if they had purchased any equipment over the last 2 years, and she said, yeah, we were always buying tools. We bought a trailer, and she's like, I probably could have depreciated the truck we bought as well. And so I said, yes, I encouraged her to speak with her tax preparer to discuss how many of their expenses they could have depreciated rather than expensed over the last 2 years. And if she were to go back and amend those 2 years of tax returns, how much would it change on her tax bill? I know it will change a lot on her mortgage pre-approval. So I want her to find out how much it will change on the taxes they paid over the last 2 years. Honestly, if she depreciates the truck, which she didn't expense at all, it's probably going to actually result in a tax refund for her over what she got or paid over the last 2 years. So she has the option of amending those things. And for her, it will probably mean the difference of qualifying for a $300,000 home now to qualifying for $400,000 to $450,000, depending on how those tax returns come out. So that's tip number 3. The best piece of advice I can give you if you're self-employed and you want to get a mortgage is that depreciation is your friend. Tell your accountant that your lender loves depreciation and you want to use it as much as possible instead of just expensing things. Now, there's tax consequences, right? So I'm not going to be able to promise you that it's not going to increase your tax bill, but in most cases, instead of writing off a full expense, maybe you're going to write off 80% of it in that year, and then it actually spreads the tax benefit out over future years as well, which some business owners would prefer, right? So you have to balance these goals. You have a goal of getting a home, and you also have a goal of paying as little taxes as possible. And this is a way, honestly, with depreciation to have both, at least to some extent. So go see your accountant, talk to him about that, at least for future years. Try to lean towards depreciation rather than expensing, and it will help you when we go calculate your income for the underwriter. Now, what if you pay yourself a salary? Here is where I want to bring in our very first ever Asking for a Friend segment to the podcast. Just as a reminder, if you have a specific question that you'd like me to address on the podcast, you can head over to my website. It's homebuyersquest.com, and on there you'll see a great big microphone right in the middle of the homepage. And you just click it and record a voice memo for me, and you can ask your question. And, it might be embarrassing, so you don't have to give us your name. You could tell us that you're asking for a friend. Anyway, let's go ahead and listen to Taylor's question. This is our first question on the Asking for a Friend segment.
Asking
Asking for a friend?
I'm just
Asking for a friend.
Asking for a friend?
for a friend.
For a friend.
I mean,
For a friend.
I'm self-employed now, and I have an LLC and an S-Corp. I've heard that it takes 2 years for me to be able to buy a house or qualify for a mortgage. But if I W-2 myself for the payroll, does that shorten the time frame, or do I still have to wait the 2 years?
Great question, Taylor. Thank you so much. I have a lot of clients who ask this question. Often it's just, we're trying to brainstorm on how to qualify for more, and they say, well, what if I give myself a raise? I mean, they know that salary is treated very differently than self-employed income. Unfortunately, it's a total myth to think that you can give yourself a raise and up your qualifying income. If you're a business owner, the calculations just average everything together over the last 2 years. So if last year's salary was $30,000 and your profits were $30,000, then you have $60,000 in qualifying income. And if this year you bump up your salary to $50,000, which then pushes your profits down to $10,000, you still have $60,000 in qualifying income. There may be some room there if you have a spouse who works for your company but isn't an owner. You may be able to do something like that and give him or her a raise, but you have to be careful because underwriters are smart. And if this looks like a temporary trick to make a loan work, they will just disallow it, right? Usually in cases where a family member has new income from another family member, it doesn't even matter if they're business owners or not, they get very focused on that and they're going to scrutinize it. They're going to want to see lots of pay stubs, lots of bank deposits. Often they'll want 6 months of history before they'll consider those kind of increases coming from family, right? They're trying to establish that the income is stable and that it's going to continue, and that's their goal when they do that. Okay, so let's move on to tip number 4. Tip number 4 I have for you is to have the business pay the bills for the business debts, the monthly payments, strictly from the business bank account. When we set up your mortgage file, we're probably going to see loans on your credit that actually belong to the business. Often I see a credit card, a vehicle or two, a trailer, things like that. And if we can prove that the business has been paying that debt for 12 consecutive months, we can exclude the debt from your debt-to-income ratio. Think about it. If you are already being hit with that debt on your tax returns, and that's how we're deriving your income for the loan, we shouldn't be hitting you again with the same debt when we calculate your debt-to-income ratio. So the problem is, if you are paying for that debt out of your own personal bank account, even if it's just one payment out of the last 12 that came from your personal account, or if you don't yet have 12 months of history of the business paying it, then we can't exclude it from your debt ratio. So my client yesterday was not doing any of that. And I encouraged her, start today to pay for the business truck out of the business account. It may not help her right now. We'll probably still qualify without that, but it will next time. It will help her. Next time when she wants to refinance, when rates go down in a couple of years, it's going to help her qualify by being able to just ignore that truck payment. Okay, so now I want to turn my attention to the non-QM loans. These loans are available for people who just cannot make the tax returns work. I met with a different client this week, a young man who said he told his accountant that he was willing to pay more taxes to get a house. And the accountant said, even if you pay more, you may not get approved. You don't know. And I think that was a really smart answer because, this client had never met with a lender, never looked at his credit, never looked at his actual income level that might show on the taxes, right? Hadn't talked about down payment options. He was just willing to start paying more taxes so that hopefully maybe someday he could get a loan. And this accountant told him, look, just look at the non-QM stuff. You don't need to pay a bunch of taxes over the next 2 years. He said, I've been helping a lot of clients by providing signed profit and loss letters and other things to help them qualify without showing the tax return to the lender. So let's talk about 3 different non-QM, maybe 4 different non-QM options for calculating your income. The laws now state there's regulation that says we have to verify your ability to pay the loan. We used to actually do stated income loans years ago where you could just say on the loan application how much money you make, and we wouldn't verify that. And that's been basically outlawed. So lenders are required to verify how much income you make, but they aren't required to use tax returns. So the most common one is a bank statement loan, where you can submit 12 to 24 months of business bank statements, and we will analyze the deposits and total them up. And then we just apply an expense factor. So expense factors depend on your qualifications and your business. A good application and a business with minimal overhead, like a consultant or home-based professional, may only have maybe a 10% expense factor. More common is 30% to 50%. So that client that I met with yesterday, they showed $150,000 of revenue. If we took a 30% expense factor to that, we would have $105,000 of qualifying income to use on their loan. That's much more than the $50,000 profits that they showed on their last 2 years of tax returns. So that's one option, is bank statements. Another option is 1099s. So when you get a 1099, you typically put that on the top line of your tax return, and then you write off a bunch of expenses and try to show zero to the IRS, right? So remember, even if on taxes you're expensing 80%, if we instead don't use the taxes and we just take your 1099s and we add them up and we take an expense factor, again, maybe 10, 30%, somewhere in that range, and sometimes it's up to 50% or more depending on the type of business you have. But again, we might be able to use 80% of that income instead of 20% of that income. So we can use bank statements with an expense factor. We can use 1099s instead and apply an expense factor. And another form that's getting more and more common is just a profit and loss letter that it's signed by your accountant. Now, it's not that uncommon for a business to keep different sets of books or produce different sets of accounting reports for different consumers of that data. So it kind of sounds like cooking the books, but I assure you that it's not. It's just common accounting practice. Your accountant may choose to provide a different profit and loss picture to the IRS than he or she would to your potential investors or bankers or partners. In both cases, they're still following generally accepted accounting principles. So the second version of your P&L can be accepted on a non-QM loan instead of tax returns, and that verifies your income. And in that case, we wouldn't even be doing an expense factor because it's already factored into the expenses that your CPA put on the letter or your tax preparer, right? And then one more option in the non-QM world that I just want to touch on briefly is for buying rental properties, and that's a DSCR loan. It stands for Debt Service Coverage Ratio, and it's just fancy language for, does the rent cover the mortgage? Does it service the debt? So if you're looking to buy a rental and the rent covers 100% of the mortgage payment, or even 75% of it in some cases, we can just use that to verify the income. And we don't need anything else. We don't need tax returns, don't need W-2s. It's very simple. It's actually a dream come true for a self-employed person who's trying to build a portfolio of rental properties. There's a lot of people that just buy over and over using these DSCR loans. Just remember that program doesn't apply to a primary residence because there's no rental income, right? The thing you have to remember about all of these non-QM programs is that you'll need more down payment for them. There's no zero down in the non-QM world. And all of these great programs that we talk about here on the podcast, FHA, which is 3.5% down, VA, which is zero down, USDA, which is zero down, they do not have non-QM income options. Those are all, show us your tax returns type of loans. So you're going to have to do probably 10% or more, depending on your credit score, for a down payment in order to do a non-QM loan, and you will usually have a slightly higher interest rate. And that rate spread depends, it varies from time to time. Often it's only 1/4 to 0.5% higher than the going conventional rate. Sometimes it's a point or more higher. It kind of depends on the market's appetite for these programs, how they're selling in the bond market at the time, and also it depends on your own qualifications. So if you have a big down payment and great credit, and you can show lots of income using one of these methods, we can probably find you a rate and a free fee structure that's not that different from a conventional loan. So that's tip number 5, and that is just compare the non-QM options to a conventional. And overall, what costs you more? Will it increase your tax bill to try to fit the mold of conventional? And if not, then I recommend we make those changes like taking advantage of depreciation and we go conventional. It's just a cheaper mortgage. Or would you be better off taking a slightly higher interest rate and making a larger down payment on a non-QM loan rather than paying the IRS more money? And these are questions that I can help you with along with your accountant. We can help you analyze that. And then once you have the numbers in front of you, it's usually a pretty easy decision. Okay, so those are the 5 tips. I just want to review them. Number 1, look to see if a 1-year average is an option for you to show higher income. Number 2, go ahead and send me those 2 years of taxes. Don't be afraid. Let me do the full calculation, including all of the add backs. You might be surprised to see how much you qualify for. Number 3, tell your accountant that you want to depreciate as much as possible rather than expense. See what that does to your tax bill, because it will definitely do a lot for your qualifications on a mortgage. Number 4, make sure your business is paying its own debts strictly out of its own bank account so that we can ignore those payments on the debt-to-income ratio calculation. And number 5, get a quote for a non-QM option and compare the costs. Perhaps that's the right path for you. All right, well, that's my episode for business owners. Thanks again for listening. I love helping business owners get ready, and I would love to help you game plan and strategize, especially if you've had another loan officer send you away without putting any real effort into calculating the income properly or looking for your best loan program. That's what I do, and I'd love to meet with you. Thank you for listening. Thank you, Taylor, by the way, for your question on the Asking for a Friend segment. I'd love to see more of those. And we'll see you all on the next episode.
Thank you for listening to the Utah Homebuyers Quest podcast with Nelson Bars, your place for a strong dose of inspiration and knowledge so you can stay on top of your quest for home ownership. If you have a question or comment for the show, we'd love to hear from you. Visit homebuyersquest.com to record a voice memo or submit your question. You can also join our Facebook community to interact with experts and fellow travelers. Search Homebuyers Quest on Facebook to find the group and join the conversation. But with just a simple click to subscribe, we'll invite you back to the next episode. And remember, we believe in home ownership and we believe in you.